Good morning, everyone. Welcome to the Macro Snapshot. Just for the record, we are Thursday, July the 17th, 2025. Recording this, about 7:30 in the morning. Okay, so let's have a quick look. We all know what happened yesterday. We got this sort of headline coming out across the news wires and whatnot. Bloomberg, about 11 o'clock, Trump indicated that he'll fire Powell. According to lawmakers, according to CBS, Trump asked the GOP, so the Republicans, on Tuesday about firing Powell. So the thing is that the market sort of reacted that as one would expect. And we have to assume that was some kind of a trial balloon, kind of a test of the market. Trump maybe sort of gauging market reaction. And the market reacted as was to be expected. So we saw that the stocks sold off. And I'm going to put this on a sort of a daily chart here. You see here, the stocks sold off, instantaneously, but very soon once it was denied. And of course, Trump came out, as is his wont, an hour later and said he'd never shown the resignation, the letter of dismissal. He'd never sort of mentioned that. He doesn't like Trump. He doesn't like Powell. He'd like Powell to resign. It would be better for the country, et cetera, et cetera. But what's very ironic in all of this, of course, is that if you look at the dot plot and all the members on the FOMC committee, it is a committee of, there's about at least 4 or 5 people who are probably actually more hawkish than and Powell, if you look at the dot plot. So technically Trump would have to sort of fire not only Powell, but another 5 or 6 committee members who basically at the last dot plot at the last meeting put down a 0 cuts for 2025. So Trump is misinformed, but that's okay. So we saw the stocks coming off. But what's interesting is just to sort of what we had been expecting actually sort of materialized in the sense that how would the markets react? And what we did see was pretty interesting. We saw the dollar selling off pretty hard. You can see here on the dollar index, you see this red candle here kind of, sort of rip down pretty aggressively. And that's just on the notion of less Fed independence. It's turning the US into a country like, I don't know, with less independence of the central bank like Russia or Turkey. Notoriously, we had Erdogan, the president, if you remember, 2 or 3 years ago, demanding that rates be cut with very, very high inflation. And we all know what happened to the Turkish lira. It lost, 100% of its value, or 90% of its value. Anyway, the point is here, the US dollar is a push downwards. But again, you see it's come back quite strongly now, up testing the 50-day moving average. What was also interesting, apart from the stocks in the US dollar, is also gold had a bit of a rally, but subsequently gave it back as well. But in terms of the bonds, I just want to concentrate on the bonds. Really, it was we saw the front end bonds, so the 2-year and to a lesser extent the 5-year, they had a strong rally, and immediately the long end sold off. So we had a pretty aggressive kind of steepening of the curve. And I'll just put it here on, let's say, the 2s30s, I guess. So put it on the 2s30s, and you can see here that we did have a pretty big steepening, which has given back a little bit here. So there's the 2s30s, you see that steepened. If we put it the 5s30s, also sort of steepening, and then let's have a look at the 2s10s steepening. And this is really a concern for a lot of things. This makes a lot of sense in the sense that obviously the logic here is that if Powell were to be fired, that presumably Trump's new nominee would be more dovish, and there'd be a lot of pressure to cut rates immediately. So we have the front end of the yields going, the front end prices going up and the yields going down aggressively. But of course, that also implies potentially much more inflation, less fight against inflation, which is not good for the long end, and maybe so that would cause the long end sort of yields to go up, compared to the front end yields, which it gives you that steepener. And of course, just a general lack in the US sort of financial ecosystem, and that's very, very important. And getting onto that point, so all that to say that a lot of those market moves, they were more or less reversed within sort of an hour or two yesterday, once Trump started to come out and sort of deny it and say that even though, as I said, he didn't like Powell, he would probably not fire him. But what's interesting, just in terms of this trust, in terms of US data, we do have some data coming out. I think it's at 4 o'clock this afternoon. We have the tick data, which is where are we? I just have it. Yeah, the tick flows. So that's sort of the Treasury sort of data coming out at 4 o'clock, which essentially says gives us detail about what foreign countries, overseas countries, what they're doing with the US Treasury. Are they buying US Treasuries, or are they not buying as many US Treasuries? And that's sort of interesting, just in terms of whether there's any kind of sort of rotation away from the US Treasury market. Less trust in US denominated financial assets. And just to finish up on the Trump thing and Powell, whatever happens, we now know that, and this is something I've never seen, just looking at markets for a certain amount of time at this point, is when the US presidency is undermining the authority and the independence of the central bank. No matter what happens in this specific case with Powell, it's sort of set a precedent and is, in a certain sense, is kind of normalizing or socializing the idea that the White House and the executive should have the ability and will take its possibility to intervene in the independence of the US Federal Reserve. And of course, you have to ask yourself, medium term, what are the sort of the effects of that in terms of trust in the US dollar and US dollar denominated assets long term. It's not as though everyone's going to start selling treasuries tomorrow morning, but you have to say that, is this the beginning of some sort of long historical sort of degradation of trust in the US financial ecosystem as represented by the independence of the US Fed? We shall see what's going on. Okay, so apart from that, we've got some other interesting data today. Again, we had the CPI, we had the PPI yesterday, which was a little bit weaker than expected, but really just reading a lot of analysis of especially the CPI numbers over the last kind of 48 hours since this has come out. It seems to be that most of, economists who are really crunching all the numbers, basically saying that some of the elements which feed into the core PCE will tick up a little bit. And also that, if you go through all of the subcomponents which make up the CPI, that there is starting to be some sort of small reflection of tariff pricing going up. We shall see. So it's always going to be interesting. On the other hand, I was reading something this morning that sort of delinquency levels are going up. People are maxing out their credit card more. The number of foreclosures on houses is rising. So there is this idea that sort of American households are a little bit starting to feel a bit more pain, a little bit more stress. They're using more debt to sort of live their life, so to speak. And so I just wonder if this is sort of evidence of wages are not going up as much, inflation remains sticky, and there's starting to be some moves. So we don't know. This is a sort of a complex issue, so we have to watch the data. And we do get some data today. We get retail sales. This is for, as you can see, the June period. So this is ostensibly sort of 6 to 8 weeks after sort of Liberation Day, which was April the 2nd. So let's just see if there's any effect here. As always, the ones to watch are probably there's the monthly number, excluding automobiles and gasoline. Also the control group, which also excludes things like sort of home renovations and stuff like that. So probably the most important number to watch here is the control group. This is a very sort of a bumpy number, quite volatile. So the revisions are also pretty important. Let's see there and get a bit more information about what's going on with the US consumer. Also at 8:30, we get the import price index, and that's going to be interesting. Let's look at this one, excluding petroleum, just to sort of see. And the reason we want to look at this is just to get a sense of, are import prices going up, which of course would be logical if one believes that the tariffs are adding sort of to the price of goods being imported into the US. So that's something which often doesn't get a huge amount of attention, but definitely I think the market will be looking at that with a bit more sort of focus this morning. Then, of course, we get the employment data. We get the initial jobless claims expected to come in, a tiny bit higher than last week at 233. Again, I repeat, that's still a very, very good number. That's still indicative of a labor market which is very, very strong. So there's no reason to panic. Really, for the Fed to sort of sit up and take notice of initial jobless claims. As I keep on saying, this would have to, immediately start getting into the late 200s, 275, 280, even over 300 for consecutive weeks to really sort of give us a sense that the labor market was facing problems. As always, we'll keep a look on the continuing claims. And one of the thoughts here is, one of the sort of the logics is for the labor market. The idea is that because there are less immigrants coming into the US for in terms of policy and Trump and whatnot, the pool of available labor is shrinking, is less and less. And therefore, it's kind of masking, in a certain sense, sort of potential weakness in the US labor market. So the fact that there's not this expanding pool of labor means that the diminished pool of labor is making it a little less tough to find a job. But what does seem to be happening is that companies are not hiring new people, so they're not employing new people. But on the other hand, they're still a little bit reticent to fire people because it's difficult to find skilled workers. So there seems to be a sort of equilibrium point where there's not really expansion in the labor market, but there's not a lot of, as I say, sort of firing going on. So it's relatively stable. And it's interesting to look at. My point is that if you look at the continuing claims, that is the ability, how fast can people find a new job? And if that number is sort of rising, and the time it takes to find a new job is lengthening, that is not a good sign. As always for the continuing claims, it's always a good idea here. I've just brought up the 4-day, the 4-week moving average, because it is kind of a volatile number. And as you can see, I was saying the last couple of weeks, it seemed to be sort of going up a little bit. You sort of look at it, and then suddenly last week the number came down. So again, it's a difficult one to draw immediate conclusions. What we can say, I mean, that's where we're at. As you see there, you could argue that it is slowly trending upwards. But if we just drag this back a little bit, let's drag it back. I mean, obviously, COVID was its own situation. So there's COVID as we came out of the. I mean, look at COVID just for crazy perspective. I mean, don't even know if it stays on the chart. There you go. So there's COVID. But what we can see is that pre-COVID, a healthy economy is. Turning over about, initial jobless claims about, 200, 230, 240,000 a week. Then, of course, COVID was its own reality, shall we just say that. But basically, since COVID, you can see that the US labor market on today is, it's relatively good. So we've had anything from only 200,000 initial jobless claims. You could argue that we're getting to the top of that range, 240. But again, my experiences of sort of recessions, looking at recessions in the US, you're normally looking at numbers more like 280, 300, 350,000, even up to, 380, 400,000. So we're still a long, long way from that. So unless and until we get a shock in these numbers, no reason for the Fed to pause. Now, talking of the Fed, we get a few more Fed speakers today. Who do we have? We have Kugler, Daly, Cook, and Waller. Waller has been relatively dovish in interest lately, so it's going to be interesting to see his comments. So we had some speakers yesterday, including Williams. They studiously avoided, talking about Trump. So let's just see what they have to say, whether they're sort of closing ranks and continuing the narrative. From what I've seen of the Fed speakers, most of them seem to be still focused on the idea that they do still worry about inflation, the uncertainty of tariffs, and there's no real need, no real hurry to cut soon. So if we look at that, you can see here that still, for July. Well, no one thinks they'll cut in July, but even going out to September, 14 basis points out of 25. So, about a 55, 50, 60% chance of the cut still, but definitely that's not sort of priced in. And if you go out, my favorite, looking out to the end of December, you can see we're down to only 1.7 cuts, so 44 basis points only. And just to get a sense of how that changed, you can see, here on the intraday, the very short-term tick chart, you see here that just before that headline about Powell being fired, the market was pricing in by the end of the year about 44 basis points. And you can see here just that sort of collapsed dovishly down to about 52. So we got a move there of about 8 basis points of extra cuts being priced in, which, as those front end yields kind of completely collapsed, just on the idea that a potential replacement for Powell would be much more dovish. But then again, with the denial, you can see here just even a few minutes later that reverse, like all the other market moves, and sort of pushed up. So here we are this morning at about 44 basis points of cuts priced in, just less than 2. Let's see what happens to retail sales and jobless claims. It's all part of the mix to see what happens. Apart from that, we had TSMC, the chip makers' earnings, which came in pretty good. They were actually, they basically said in the commentary, which I read, they said that customs was still, buying with, a lot of confidence, although there are some concerns and caution regarding Q4. Basically the lack of certainty around sort of tariff policy, but nonetheless, TSMC that had good earnings, positive earnings. We have Pepsi and Netflix today, so let's see what they have to say. And it's going to be interesting, more of like consumer demand, Pepsi, Netflix, sort of consumer discretionary demand. So that's maybe the lens through which we can look at that. So that's just about it. Well, and so just finally, just want to have a quick look at the Aussie dollar, because we had Aussie employment last night, which actually the unemployment rate ticked up. It had been 4.1, and it ticked up to 4.3%. So that's unwelcome news for the Reserve Bank of Australia. If we actually just look at the Australian dollar here, which is here. Obviously, Aussie dollar. So you can see here it had a pretty nasty sell-off. That's a combination of that domestic data, sort of the worsening unemployment situation. And of course, on the other side, a lot of this, 60, 70, 80% of this is probably just US dollar. And we can see this morning that the US dollar is regaining a little bit of strength. So increasingly, just looking at the US dollar, and let's look at, let's say, the euro as well. You can see here that, this is quite a critical point here for the euro. We're at this uptrend line. I think I talked about this yesterday. We're broken down now on the short term Fibonacci. So we're now breaking down below the 61.8 fib retracement here. So if it breaks that fib retracement and breaks this sort of uptrend, which has been in place since sort of the end of March here, that would be a little bit of technical damage. And at least you'd expect the euro to maybe test downwards towards the 50-day moving average. But there's quite a lot of support just underneath that at around about 114.80 or so. 114.90, around about that area. So we could see a little bit of a pause there. And that's been reflected everywhere. We also see the pound under a little bit of pressure, and we see the US dollar, apart from that hiccup yesterday against the Japanese yen, you can see that's pushing a lot higher, coming up to substantial resistance. You can see on this sort of horizontal resistance level here, this is a pretty key level here, 149.6. I expect that to sort of have a pause there. But you have to say at this point, the short squeeze is happening, and whether it's just a short squeeze or actually a reversal, because the bulls are doing well. You've got the 20 crossing over the 50. The USD JPY is now above the 200-day EMA and doing pretty well. And so it's also getting above a few sort of fib levels here. So at this point, it looks as though I think there's a little more upside in the US dollar. But again, well, let's see the data. We'll see the Fed speak today, what's going on. And just keep an eye here on the dollar index, as you can see here at the 50-day moving average. So it's broken, fairly convincingly out of this sort of downtrend line. Okay. Now we see the 20-day turning up. So the trend is still down, but you have to say that the faster trend lines here, or EMAs, the 20 and the 50s, they are starting to flatten out a little bit. There's definitely, you see the 20 turning up, you see the 50 starting to flatten out. So this is quite an interesting sort of few days coming up, because if this continues to go up, any weak shorts here, they're going to be squeezed, and we're going to start getting some stop losses. There should be quite a few stop losses at, let's say, the 99.4 level, around there, 99.5. So if we get up to there, that could run the stops just back up to the key psychological 100 level. Let's keep an eye out for that. Okay, so I'll wrap it up there. Have a great trading day, and we shall keep the conversation going. Thank you.